Hi, Keith.
Oh, hey guys, can you hear me?
Yeah, I can hear you
Hey, we
now.
can hear you.
Awesome. How's everyone this morning?
Good, Keith. Really a pleasure to meet you. Thanks for taking out some time to address our community. And I've been to your website and read a little bit about your journey. Tell us how, even before you became an investment
Coach, should we
advisor.
help him share his screen first?
Sure.
Okay. There is a share button. It has a green color in
Sure.
the Zoom panel. Once you click it, it's going to ask you which screen or window you want to share. Yeah, there you go. Perfect. Okay. Enjoy
Oh,
the
Okay.
interview.
does that look good, guys?
Yeah.
Perfect. Yeah, perfect. We can see you.
Okay. So ice cap. Why ice cap, Keith? Because you only see what's above the surface, and the important things to see are how much larger the iceberg can be underneath it.
Yeah, absolutely. You get all that sort of thematic story around that, also from the part of the world where I'm from. I'm up here in Canada, Nova Scotia, and over in
Okay.
Newfoundland for a bit as well. So we've seen quite a bit of that. I think one thing just to share with everyone, how much time do we have, by the way?
As much as you want, 20, 30 minutes.
Okay, so
Approx.
we'll zip through a few things.
Okay.
So first of all, do you want me to talk or do you want to ask
Yeah,
questions?
no, I no, I see your history here on, I'm looking at your website, and what were you doing before you got into the investment business? What was the catalyst for you deciding to go this way? I know a lot of Canadians have like a natural interest in natural resources. So, was that it? Just, your geography, um, brought some interest into you of mineral and oil markets?
It's not really a cool story. I've had
Okay.
I just had an interest in markets. So when I finished high school, I went to university. I knew exactly which path I wanted to take. And
Wow.
I've always, taken the approach that if you're a nice person and be nice to everyone else, but be a little bit passive aggressive in terms of knocking on doors and getting in and having some vision where to go, which directions. You'll get a few breaks along the way and make some great friends, and then if you're smart about it, good things will happen. So I've had some good breaks along the way, which has worked out.
Okay. All right. So let's talk about what you brought to share with us. So go ahead.
Yeah, sure. So with our firm, so to give you a little quick background. So I founded IceCap about a little over 10 years ago. We manage money for investors literally around the world. So Canada, US, some European, and over in Asia as well. We manage
Is it
long
hedge
only.
funds?
Well, we manage long only portfolios as well as a hedge fund, special purpose.
Okay.
So
Okay.
for our long only mandates, if we don't like something, you avoid it, of course.
Right.
For the other platform, if we don't like something, then there's things that you can do to take advantage of that. So that was the main reason why we set it up. So we'll run through the slide deck here and give you an idea how we see things.
Okay.
So we are global macro, and we're not bottom up stock pickers. We're not very specific with being a technician or anything like that. Like we've had a lot of success because we've correctly identified what the global macro story is. And so to give you an idea how strongly we felt about this, it was last summer. So Brent Johnson from Santiago Capital, Brent and I set up the structure to specifically take advantage of opportunities we saw out there. So we've always known that markets were perfectly positioned so that there would be a trigger event along the way. And once that trigger event happened, it was going to cause the US dollar to appreciate rapidly. And you're going to have to see various knock-on effects across credit markets, duration, volatility, as well as equities and currency markets. And all that is starting to play right now. So as you think of more or less like a domino effect, and that you need that first one to fall first, which means the next one will fall and so forth. So these are all starting to line up right now. I just want to share with you how we see things.
I believe I've interviewed Brent.
Oh yeah, okay, good.
Yeah.
So it's sort of similar story, and
yeah, he's a super dollar bull.
yeah, so I'm in that camp as well, and
Okay.
We look at it from different perspectives, and that's how we came to the same conclusion.
Confluence between different methodology, huh?
Mhm. Yeah,
Okay.
which is just brilliant in the investment world.
Yeah.
So very quickly, just from a regulatory perspective, this is not investment advice at all. So we're just sharing with you some way to look at things. And we're not selling any products or services at all. So I just want to explain first why currency markets are perfectly positioned to experience re-escalation of stress and crisis. And the main reason for it, because everything I'm going to share with everyone right now is that what's happening and what's about to happen, no one in our lifetime have experienced it before. So because we tend to be linear thinking in the Western world, if it hasn't happened in our lifetime,
it
then
never will. Yeah.
Yeah, it'll never happen. Like, remember the housing crisis,
Sure.
Remember,
they only go up. Yeah.
Yeah, I remember back then somebody was telling me, well, in history, you've never had a national crisis in the housing market in the US, so whatever. So looking at this chart right here, again, like very simple, but if you're going back now over 70 years, so back in the 50s after World War II, US GDP made up about 28% of global GDP. That's what you're looking at. And then over 60, 70 years, it's declined. And we all know that the US is still the largest economy, but its percentage share of growth has been declining, and China has been rising rapidly and so forth. So you have a declining importance of the US economy around the world. But at the same time, the green line, what we're showing you is that the percentage of countries that are using the dollar as a peg or a anchor currency or a US dollar world, you can see that it's doubled during that time. So
Why?
again, the main thing, global trade, the dollar has become the world's reserve currency, and there's no alternative. There's nothing else out there whatsoever. So you picture this in the background: weakening US economy, more people are using the dollar. The next thing to consider is that back in the 50s, you look at, okay, who was in the dollar world? And a lot of it, look at from an economic perspective, but still a lot of the world was not dollar focused. Look at it today, it's a dollar world.
Nice map, beautiful visual, yeah.
Yeah, it tells the story very well. And then the next thing,
now when we see red, we think it's the virus.
Yeah,
the red maps. Go ahead, buddy.
Yeah. So the next one we look at here, and again, this is the key. Back after World War II, we've had Bretton Woods and all that, but all currencies were fixed in one way or the other, either fixed to another currency or fixed to gold or whatever. But it was an environment where if there's any risk to be reflected in the world, it was not going to be expressed in currency markets. We look around today, in almost the entire world, we're in a floating currency world today. Even though Europe is showing fixed, that just means those countries are fixed to the euro. That's it. Euro is free floating as well.
Okay, interesting.
So we have this perfect environment where, now we can actually see risk or re-escalation of stress get reflected in the currency world. Again, no one has seen that before, so they're not expecting it. And then if we look along here, I think most people are familiar with Keynesian economics. Central banks will control rates, and then finance departments or treasuries on the fiscal side, they'll spend more or less, and fool around with tax rates and so forth. But if you step real far back, you can see that we're always getting different themes, what's happening in the world. That's what's really driving markets. And as each theme has hit its peak and then went into crisis, central banks would roll around to bail everyone out, basically. Same with the treasuries at the sovereign level. And so we were getting a successive larger and larger crisis as we've been going. So the story that we've been looking at now for a while is really that we feel pretty strongly that the next crisis that's building, it is in the bond world. It'll get reflected in currency markets. And that's exactly where we are right now.
You know,
So
I agree with you, Keith. You know, everyone's so focused on equities and the crash in equities. And when I look at like LQD and the decline that we had even in treasuries during the crash, and the range tells me that things are out of control.
yeah, it's like in Canada here. I don't know if we have many Canadians on the call today. I'm not sure if you're aware of what happened on Friday.
Yeah, we have some loonies here at ForexAnalytix.
Okay.
I'm kind of a loony, but I'm
There
in
you go.
California. But go ahead, buddy.
Yeah. So, people know now on Friday morning, the Bank of Canada, they cut rates by 50 basis points, intermediate cut, which is, it's pretty dramatic. But to have to do it on Friday morning, before the weekend,
Yeah.
That immediately tells me, wow, something is wrong here. And so people in my network that I've connected with, they say, Keith, like things completely stopped working. And on Thursday night, so they had to immediately come out again Friday morning, not only with the rate cut, but, they're doing QE now, they're buying corporate bonds. They effectively went to the banks and said, hey, we'll buy 15% of your mortgage book and you guys can choose what you want to sell us. Things.
Well, our Fed too, right, Keith? I mean, they didn't even wait for the meeting to take their emergency actions.
Yeah, it's much more stressful in the system today than it was 10 years ago. And I know everyone everyone will look at equities every morning they get up and during the day, because I tend to say equities are one-dimensional. That's it. I mean, everyone can figure out if they're doing well or not. Fixed income is multi-dimensional. I mean, you have credit spreads, you have FX involved with it, you have duration, you have issuer. I mean, it's so complicated that for mainstream media to have a quick 10-second blurb, they can't do it. But this is how we view things right now. And because, things are so bad out there, and with us as money managers, to be very clear, we are objective. We never let our emotions affect how we see things. There's always an opportunity to make or lose money, and that's the way you should see it. So we use this now. We view this as a global macro world, and this has been going on for a while, and now it's finally coming into play. And again, this just all these headlines. These were happening last year, before this crisis took place.
Right, that's a key, isn't it, Keith? I mean, people are going to use, and financial pundits are going to use the COVID-19 as the excuse for everything. But we were having trouble in the repo market last fall, and we already were in a manufacturing recession, not service recession, before the virus became a pandemic. And it's being used as the excuse for everything, isn't it?
Yeah, it really is. And, for us, like we did not, we certainly didn't, predict or forecast that a virus coming out of China would be the trigger point. But from an economic perspective, it's irrelevant. Something would happen to cause this to be triggered. And now it is happening. So they can't stop it from an economic perspective. I don't mean the virus, I mean with the way markets are moving.
Right.
And in my mind, you could see these things are set up perfectly. And as I mentioned, if step one happens, step two is going to happen. Then the next wave will happen. So we're pretty excited about what's coming up here in terms of opportunities to make money. Very quickly, if anyone follows velocity of money, velocity of money is another way to measure GDP in the US. Is simply the change in the money supply multiplied by a multiplier. So if the economy is growing faster, it swirls around faster in the economy and so forth. So despite having, with trillions in QE around the world, zero, negative rates and so forth, the velocity of money is still plummeting here. So that's always said, hey, there's a problem.
How was the market able to rally? It was a dramatic bull market, right? So and a lot of the bears would point towards velocity for several years. How were they able to engineer? Was it all psychology, despite velocity, that created this bubble in the first place?
Yeah, our view on equities. To So we're not fundamental managers. You know, I'm showing you a fundamental story, but we never use fundamentals as a reason to, you know, to buy or
They're
sell.
not your triggers.
So as an example for everyone, for our equity exposure, we've been fully invested over the last 10 years. And, you know, a lot of people, they're surprised. They say, well, you know, you guys are pretty bearish on stuff. And I say, yeah, however, for equity markets, so we've had a lot of success using trend and momentum models, as well as a couple other models that measures the, you know, the overall strength of the underlying market. And by using those two models combined, it allows you to remove your subjectivity, which is what fundamental analysis is. So you know, it's kept us invested for a long time. So I like to say, you know, people would, you know, the bears would say, well, equities, they should not be going up. I want to stay in cash. And I say, yeah, but they are going up. So, you know, again, it's really listening to the market. The strongest thing you can have in the market is a bull market, and it's really irrelevant why it's going up. You know, you have to be invested when it is, and when it turns, then you know, you get out as well. So, you know, on our long only portfolios, we've reduced equities twice, back in February and again in early March, because our models, they turn immediately. So again, there's always opportunities to do things. But let's just look at this here real quickly.
Go ahead.
This is the longest economic expansion that we've ever had in the U.S.
Yeah.
But it's also been, I should say, that expansion is now over, of course, but before this hit, it was also the weakest economic expansion. So for each additional dollar of debt, you know, the economic output was less and less. And again, it just tells you this is weak, it's going to end. This is probably one of the most important relationships to understand right now, specifically for fixed income markets. So, you know, typically you always want to look for an asymmetrical risk-return relationship. So that's one, for example, if your opportunity at making money or losing money is 50-50, you don't really want to get involved with that as an investment. If it's a 80% opportunity to make money, 20% to lose, yeah, you like that. If it was the opposite, then why would you do it? With fixed income markets right now, Dale, we've had now 40 years just about of declining long-term rates and tightening credit spreads. It's been impossible to lose money in the bond world.
Yeah.
And now all that has flipped around completely. So your upside is, you know, say 2%, and your downside is its multiples. And you know, the unfortunate thing about this is that the industry, we always make a big difference between the industry and the market. So, you know, the market is the market, but the industry, you know, they've been very guilty of pushing conservative investors into bond strategies, which have in turn, you know, dwarfed into exposure to high yield, emerging market debt, preferred shares. So the most conservative investors in the world, in our opinion, they're now sitting on this like boatload of risk.
Yeah, they're sitting on dynamite and think they're being conservative.
Yeah, so that's the next wave that we expect to come up here. So we've had equities get hit pretty hard, and we think credit markets will be next.
And the bond markets, Keith, are how much larger than all the combined bourses on the globe? 5-10 times the size?
Yeah, you look at 10 plus. And then
10 plus, okay.
Yeah, and then you look at currency on top of that, which is also, you know, a derivative of fixed income. It's a pretty big market. But the big difference with fixed income, of course, that there's no exchange. Everything is either inventory dealer held or held by, you know, institutions. So when you need liquidity, it doesn't exist. It's pretty tough.
That's a real important point, isn't it? Yeah. Okay.
Yeah, it's just incredible. I write a piece 4 to 6 times a year. We get a lot of interest in it. But the last one I wrote was called The Invisible Hand. And what I'm describing there, so everyone knows Adam Smith, The Invisible Hand. You know, that's how you know, something will get priced. This is the yield curve, you know, a theoretical yield curve around the world. And we've been, you know, talking for a while that, you know, that red line, especially in Europe, it's been suppressed. So I like to say, you know, the global yield curve has been artificially suppressed. And this is going to return to market pricing at some point. Mm-hmm. And when it does, it's going to be a bit shocking for people who are not used to rates shooting up. Again, we look at FX volatility. It's been at record lows, no matter which cross you're looking at.
Yeah.
Same with bond market volatility. the complacency, it's just lulling everyone to sleep. And again, all this was produced before this crisis hit everyone. We look here at credit spreads for an investment grade. Again, it's priced to perfection. You cannot get any tighter than this. And then this is my favorite sort of story to tell. As I mentioned earlier, that few people are around today. So this is the U.S. 10-year chart, the long-term. We all know that when long-term rates go up, bonds lose money. And when long-term rates go down, everyone makes money. Everyone around today has worked in the business from, number 3 in the blue bubble right down to number 4. That's what it's been. So everyone, like Bill Gross retired a couple of years ago, and one of his comments in his exit interview, I'd call it, he said, I don't know what happened, but our strategy stopped working in 2014. And I said, yeah, no kidding. That's when long rates started to go up, and the whole duration play is over. Now, back in 2010, long rates should have started going back up then. But so with that orange dotted line in the corner, on the bottom right, that's what central banks did. That's how they suppressed the yield curve I just mentioned. So the combination of QE, zero rates, negative rates, you name it, they've kept rates down. So if they allowed rates to go up at that time, a lot of banks would close shop and all that stuff. But it would have been a clean slate, and we would, we would have reset the button. It would have been a lot of fun. Instead, here we are today. To give you an idea, just to visualize, again, the difference between the industry and the marketplace. I was chatting with someone the other day, and they said, "Oh yeah, they've been working for 10 years. You should speak with this guy." And 10 years means that your entire career has been in a period of QE, zero, and negative rates. So these people think that's normal. They think that's their normal market. So I started my career back in the early 90s, so that's where I am. The guys that mentored me, they started, mid 80s, sort of like that. So again, you have to go back a long time to find someone who's experienced a market, which we're about to go into once all this is sorted out.
Can you create another category for me?
Where do you want to go? Which one?
Let's see, 1975. So what's that? That more than 58 years? No. Anyway,
I'll say we'll put you there. That's a nice one, though.
But no, I'm in the 38-year category. A long time. All right, so I went on the floor in 75. So I was there for the Volcker move to the upside, and I remember and gold peaking, the great liquidator. And so, looking at this base that we're building, do you have any kind of idea what the magnitude of rates to the upside could be? I mean, no one ever thinks that we could go back to 1980 levels, but if there's enough of a liquidity crisis, couldn't rates sky's the limit because there's not enough demand to roll over supply?
My view is a bit. So what I expect is going to happen.
Okay.
Think of the world as a. They went from the totem pole. The Native Canadian, Native American. Yeah. Heritage. So picture the euro on top, and then in the middle is yen, Japanese yen, and then the base then is US dollars. And no other currency matters. That's it. You're going to see stress or crisis hit the eurozone next, and then the yen. And each time as this builds, the dollar is like surge higher and higher. And then at the very end, everyone in the world will want US dollars. That's what will happen. Similar to how everybody wanted, I know, sure, a Netflix a few years ago, or
Tesla.
Absolutely, Tesla, stuff like that.
Okay.
Everyone will want dollars, and then that's the moment then when the dollar will experience its crisis as well. And by that time, we will have a new kind of monetary system being forced upon us. People say, well, what will it look like? Who will control it? And, our response is, well, it doesn't really matter. It's irrelevant at this point. The fact is that we've now gone down this path where monetary policy doesn't work anymore. Fiscal policy, it's doomed. No one can tolerate higher rates. Like in Canada, for example, we had a balanced budget a few years ago, and then we went to about a $2 billion deficit, and then quickly 25, 30. With the stimulus being introduced by the Canadian government for this crisis, we'll have a deficit of, anywhere from 100, 130 billion. Like that's unbelievable. But the Americans have their equivalent. Same with the Brits, same with the Aussies, the French, you name it. There's not enough global savings in the world to absorb that demand. So as I mentioned, it is going to happen. And this is the opportunity that's available right now. So it will get reflected in credit markets as well as currencies. And again, I just don't know how we go about it. Like one thing, like Dale, so like a lot of people talk about debt jubilee. So let's write off all the debt. So that could happen. However, for that to happen first, let's use the Japanese as an example. If they say, you know what, we're going to write off the debt. So remember, one person's debt is another person's asset. So the first thing they have to do, they have to, using the central bank, they have to, using QE, have to buy all the debt that's in the market. So as soon as they do that, then, the other side, pension funds and so forth, then they're made whole on whatever they held. And then you can write off that debt. You say, you know what, we forgive it, we write it off. But as soon as you do that, your currency gets chopped in half. Of course, that will happen. But again, it's not as simple when people say, yeah, they're just going to not pay back the debt. Like the Americans can't do that.
Yeah.
They have to buy the debt first because
it's too much.
Yeah, well, a bunch of, the Fed can print a lot of money if they wanted to.
Yeah.
But, if they cancel, say, treasuries, like there's so many pension funds, government-run plans, like Social Security as well, they all hold this stuff. So it's tough.
Yeah.
The biggest problem with the dollar, or the advantage or strength, depending on your perspective, is that there's a significant portion of dollars out in the world that hasn't even touched the US. So it's being issued by emerging market countries, multinational companies, you name it. And that represents a huge demand for dollars. That's what it is. So when the Treasury, when they come out and say, we're going to run a $3 trillion deficit, to fix this crisis, that is a demand on dollars. They immediately go to the front of the line to get the dollars. And all these other emerging market entities, they're at the back of the bus. So they can't ignore this global demand that we have for dollars. Just another slide to give you an example with interest rates. No one can tolerate higher rates. So, unless we're able to suppress the yield curve, for the rest of our lives, it won't be a problem. However, we know just that's not the case at all. So that's going to be real tough. Another, again, just to give you an example here, if anyone has seen the newest bond funds that have been created over the last 2 or 3 years, they're just stuffed with high yield debt, junk bonds, and again, it's there should be lawsuits when this
the chase for yield. The higher the yield, the higher the risk.
Yeah, but the mom and dad's buying this stuff, they have no idea because they're told, oh, it's a bond, it's still safe, and all that stuff.
Sounds like MBS, mortgage-backed security.
Yeah, absolutely.
Yeah.
And so again, like this one here, the fragility of the bond universe. Again, this is pre-crisis, so the majority, looking at the high yield market, and so investment grade is down to BBB. So a significant proportion of investment grade bonds. Look at LQD, for example. A huge portion of it is it's going to get downgraded, and as soon as you're downgraded, you are not allowed to hold it in your portfolio. I don't mean everyone, but institutional funds and family offices and stuff like that. So it's pretty tough out there. So when we put all this together, again, we're not equity focused, currency. We look at all markets, and we always, again, try to be very simplistic with it. Say, where are the opportunities coming up? We'll have to adjust this a little bit as we get going. But I think though you can see the theme here. You know what we really don't like. You know what we do like. So you know
Why does
that's
gold only get one check? Because of dollar strength? One green
yeah.
check.
So we to give you an idea, we had a pretty big allocation of gold back in 11 and 12,
Yeah.
and you know those who follow the market, you know we know it broke pretty aggressively. When it did break, we were out in 3 trades. So our last trade was around 1650. So we sold at 1650 and higher, getting out. And now we know where to stay, right? So our view on gold, we can absolutely see it rising at the same time with the dollar. And then that's a sign that says, oh, wow, things are really messed up. Our concern, though, is that if we do get this sudden surge in the dollar, gold will come down immediately as well at the same time, and then thereafter. So we just make this short. You know, it's always a good idea to have a bit in your pocket or portfolio, but we think, you know, we'll have a pretty good opportunity to start adding gold to our portfolio.
You have any levels in mind? 13.5, something like that, or under 1,000?
No, because let's just say the dollar started surging this week. You know, gold could come down $200, $400, $600 or something like that. And I'm not a big believer in like a specific level because, as you know, like the moving target, like 1 week to the next, you know, you get moving averages changing and support levels. So we just think there's going to be a really good or a better opportunity. But if the opportunity doesn't come up, then it just further confirms our view that, well, if you have the dollar and gold rising at the same time, you know,
that's what we had last year.
Yeah, you need to head to your cabin or something then, because it could be.
Do you have one?
I think
well, you live in a low population density area, right?
It
Nova
is.
Scotia?
Yeah, it's true. So the.
I mean, you can't even find 10 people to be with up there, can you?
It's you know, but everyone here, truthfully, everyone is struggling the same as anywhere else. And
does the oil patch is that part of the geography where you're at, or no?
So to the east of us, Newfoundland is pretty highly correlated to Newfoundland, and you know they were struggling before this. And you know, we have a lot of dear friends out in Alberta, and you know they're really struggling as well. So like the biggest, again, this is just perspective, it's opinion. It's not fact. It's not politically motivated or anything. My fear is that if we don't get the economies back up online within the next 10 days, 2 weeks, the probability of social
unrest,
whatever word you want to use, it's going to happen. I mean, it's going to be really difficult out there. Fortunately, you know, a lot of people in my network were comfortable. You know, we're following the laws, but there were a lot of people out there that, you know, they didn't have 1 or 2 weeks savings available. And
it's like that in the U.S.
Yeah, it's going to be
like, you know, 50-60% of U.S. families don't have an extra 400 for an emergency, let alone to be stopped out trading the euro. So, you know, I mean, this is really a body blow, that $2 trillion. What do you think of the rescue package here? We've gone over, but I just want to say this, Keith. Outstanding presentation and visuals, and you know, I've done about 570 interviews here on F.A.C.E in 3 years, so I know when someone knows. So you could say it's just an opinion, and I know you're just hedging yourself, and you know, if there's a probability things change, but really great presentation. I'm so glad. I don't know why I did, but I'm so glad I reached out to you on Twitter to have you come and edify the community. So I don't know if you have more to go, but it'd be a good time to share your website. I don't know how many accredited investors are going to are here or see this video later, but is there any way for people to just follow some of your ideas in the meantime on your website?
Yeah, so I write a piece called the IceCap Global Outlook, and it's 4 to 6 times a year. You can register for that. It's free. That's on our website. On Twitter, it's at IceCap Global. And, you know, we're pretty friendly. So if anybody wants to chat anytime, just send me an email directly. You'll find me on the website or on Twitter. And if we're able to help you out, you know, we'd love for someone to become a client, of course. But if not, you know, we're always able to provide some guidance, and maybe you can get some help elsewhere. So I hope that helps.
Okay. Keith, anything you wanted to wrap it with before I award you with, now, like it or not, you're my trading warrior brother?
No, I'm fine. Just
all right.
Thanks for having me. I appreciate
Keith, it was really a pleasure, and thank you so much for.
Thank you, Keith.
You know,
Coach, it's really sad. It's really sad that so few people that, you know, follow common economic logic are being invited in the mainstream media, right? I mean, we know so many of them, and so few of them are actually, if you go to CNBC, they're going to keep telling you, buy, everything's okay, the economy is doing great.
Yeah, don't shoot the messenger. Keith is just like you, Steve.
I know, that's what I'm saying. But people like him rarely find you know, a venue that they can actually openly express, you know.
See, and I was just lucky. I took a shot on Twitter. So, you know, let's thank Twitter for bringing us together, Keith, and let's get back together a few months down the line and see how things are unfolding. What do you think?
Absolutely. Okay, guys, everyone stay safe.
All right. Thank you, Keith. That's a wrap for us, everyone. Don't just count your pips, count your blessings, and we'll see everyone tomorrow for Turnaround Tuesday. You're very welcome, everyone. Adios. Thank you, Steve. See you later at the meeting.
Bye-bye, Coach.
And see everyone in chat.
Bye-bye, everyone.
2 days left. 2 days left to join.
1.5 days left, yes.
Well, 1.5. The sands of the hourglass are like the days of our lives. Not much sand left in that hourglass. Better get going. See you later.